All right, guys, so strap in, get your coffee, and get ready to focus because now we're getting into actually execution of trades in the portfolio for Q1 2024. And especially for those who either A, don't know much about options, or B, trade options but don't know how to actually do complex ones to boost their portfolio in the right way, this particular presentation is going to be a huge lesson and give you some breakthroughs. I promise you that. So, this is going to be quite a bit long, and I'm going to talk slowly or more slower than usual. So, if you want to, you can speed up this presentation by going to 1.2 or 1.5 versus just the regular speed. But I'm going to be talking slower than usual because the information here is extremely important, not only around how to hedge, but also why options in particular, in my opinion, really from an actual meritocracy perspective, they just are the best hedge across the board. And so I'm going to show you guys what hedge I'm going to use for Q1 2024, assuming that there will be a bull market run fairly soon. So to start, here's a quick recap on why we're doing this video at all. Through this video series, we, meaning me and the people who are watching here, are building a mock portfolio for Q1 2024 with real trades live in the market with a capital exposure of $100,000 USD. I'll get into what capital exposure is in a bit, but generally just understand that we are building a portfolio with a capital exposure of $100,000. Now, through analyzing macroeconomic conditions in the previous video, if you haven't watched that, please do, we have determined that our portfolio for Q1 needs to be neutral to long. It needs to lean slightly long, but generally be neutral, okay? To give ourselves the best chance of making money, regardless of what happens in the stock market over this quarter, we need to structure our portfolio like a professional long-short portfolio manager, okay? Very important. Now, to do that, to set up a portfolio like that, you need at least 8 to 10 trades, all right, on both sides of the market, both longs and shorts, all right, that don't directly correlate with each other. Very important, but also still make money individually. Now, for those who know what correlation means, you know, if you buy, let's just say Facebook and Google, they're highly correlated. They move in the same direction most of the time, right? But Facebook and let's just say FedEx don't really move in the same direction. They're not correlated. So what we want to do is get 8 to 10 trades that are on both sides of the market, long and short, that are not directly correlated, okay? But also still make money individually. Therefore, at the same time, it creates a balanced portfolio, especially since we believe that we need to be neutral to long. We want to be as balanced as possible. But because the portfolio bias is primarily neutral for Q1, right, the hedge trade is extremely important, right, in safeguarding the entire portfolio. Because in a neutral situation, anything could happen. We can get a major short move, we can get a major long move, right? And we don't want one side of the portfolio to get really killed, which is why the hedge trade is supposed to save the correct side. So we're going to start there in terms of actually formatting our trades for the portfolio with the hedge because we are neutral. Now, the question of why to hedge at all is very important, right? In a typical long-short portfolio, you don't really need to hedge. If you have a directional bias, you really want to play that and let your trade ideas themselves really bring in the profits. But why hedge in Q1 2024? Well, we have some few interesting situations at the macro level that really could tip the scales and give us a situation. One, GDP is estimated to decline this quarter, right? Which is why we see at the top of January the market correcting downwards, right? That's, as I said before, GDP is the most important forecasting indicator for the stock market direction. So, of course, right now we're getting that correction. It was pretty much anticipated to be the case. At the same time, though, other key macroeconomic indicators are flashing signs of possible bullish reversal, okay? Here are a few of them. The Consumer Sentiment Report. Highly important because it has reached 40-year lows, right? And just like any time with any other stock chart, when you know that a stock chart hits, let's just say long-term lows, there may be a bounce. This also is the case for macro trends, right? The Consumer Sentiment Report is at a 40-year low and bounced in December. The next one is being released January 19th, which is tomorrow. Today is the 18th. Tomorrow, the next one's being released. If that one shows a bullish continuation in consumer sentiment, of course, that's going to be bullish for the market because that means people are more likely open to spend, and spending drives market action, revenues. Number two, the Federal Reserve Open Market Committee, aka the FOMC, is having an interest rate meeting, right, on January 30th. And they have been talking about possibly cutting the interest rate, which is at a 22-year high right now. That has been a major headwind on the market, aka making it hard to go up beyond the all-time highs. However, if there is a cut to the rate, right, and the interest rate goes lower, that is going to be the starting engine to the economy really super driving, and we will get some bullish momentum off of that. So watching the interest rate announcement will be very key. If it does end up being cut, this current bear market or this current correction in the market will be short-lived for sure. Number three, the government bond yield curve is normalizing, right? And that's important because right now, over the last 2 years, we've been living in an inverted yield curve. For those who don't know what that means, I'm not going to get too deep into it. But generally, when you have short-term bonds being more expensive than long-term bonds, that signals low confidence in stability in the economy, okay? Now, it's starting to normalize, which means longer-term bonds are being bought back into. And normalization means longer-term bonds will eventually be more expensive than short-term bonds, all right? So with that being said, the next long-term bond auction is reopening next week on the 20th, this Saturday, I believe, yeah. So with that being said, if we start to see more buying into long-term bonds in anticipation of something like a rate cut, that's going to make the market bullish, for sure. And lastly, GDP advanced estimate for Q4 2023 and the annual 2023 estimate is released on January 25th, okay? The way GDP data works is it's lagging in terms of the actual official prints, and the S&P tends to lead it or predict it in the future, right? So the S&P is predicting GDP, right? So if the GDP actual estimate comes in larger than expected, it will offset the GDP decline currently, and of course, we could possibly see a bullish momentum in the market. So if any of these data points come out unexpectedly strong, especially if the interest rate is cut, right, that will likely offset any kind of negative GDP sentiment and entice investors to reinvest in the market, and we will get a reversal to the upside. So that's why we need to hedge for that, right? We know we're in a current correction downward where there is more firepower to the upside, really, from a macro trend perspective. We don't want to be caught being too bearish and get caught being short squeezed. So we need a hedge to actually protect against that situation and possibly benefit from an actual bull run. That's why we're doing this. Now let's talk about, from a trader's perspective, what we would ideally want from a hedge trade, right? If we can go into our special bag of tricks and pull out the perfect hedge trade, what would that do, right? Number one, it would produce an outsized return to compensate for the losses on the shorts in the event of a major market rally or a major market reversal to the upside, okay? So whatever hedge we do needs to be able to cover the losses here, right? So ideally, if we have 3 to 4 trades up that are short, right, this hedge would actually profit 3 to 4 times in a market rally to cover these losses here. Secondly, if it goes the other way and the market keeps correcting downward, we want to make sure that the hedge isn't too expensive and that we don't lose much on it. That's a big deal because if you play a hedge and you're wrong on it, you can lose money. So we want to make sure we keep that money low. And this is where options really shine. Thirdly, if the market doesn't go necessarily farther up or farther down, we want to make sure that the hedge actually makes a little money, right? Because technically we are neutral for the actual quarter. So if the actual outcome for price action is neutral, we want to make sure we don't lose money on the hedge. And lastly, in like a fairy tale situation, right, we want to have our hedge make a lot of money in the event that the market trades sideways in the short term, right, but then begins to break out upward in the midterm time frame, which is like 30 to 60 days. Short term is within the next 30 days. The midterm is within 30 to 60 days. Right? And this is something only options can give you. I'll get into that in a bit. So when talking about the ideal hedge, it should fit all 4 of these categories and requirements. And things like futures don't quite do all four, especially doesn't do number four. And definitely creates an issue when talking about number two, right? Futures has an issue doing all four. Definitely stock shares can't do all four. Even things like commodities and currency trades can't do all four because of the risk of loss, right? And the inability to really structure a trade that is based on time. But options can, especially when we're talking about option spreads. Option spreads are great hedges. So let's get into what option spreads can do for you. Firstly, I'm going to talk about what a standard options-based hedge spread can do for you, right? So generally what option spread do, they are meant to capitalize on the market being neutral, right? So a spread allows you to profit as long as a stock's price stays within a certain particular parameter, or a certain range in this case, right? How you make those? First, I'm going to just zoom in a little bit here. You have to sell a shorter dated option contract at a particular strike price, right? So say, for example, in this case, right, I'm selling the 47.60 call, and really I'm buying the longer dated call option at the same strike in this case, in this particular use case. And the reason why that makes sense is because when you sell the shorter dated option contract, technically you are selling to a buyer. You are saying to the buyer, I bet that the stock does not go above this price by this time, right? And if you are right and it doesn't, you collect that money. You win the bet, okay, in that time frame. However, by buying the same strike call for further dated, you're saying, you know what? Even though I don't believe it's going to go beyond this price right now, I believe it's going to go beyond that price in the future, okay? So what that does for you is, as long as the stock price doesn't go beyond this price in this case, right, you are collecting money the entire time. So the more time that passes before this expires, you're collecting money. That collection offsets the price that you paid here. So technically, this one is worth more than this one, but you're collecting money on this, which allows you to make money the entire time. All right. So generally, what a lot of traders do with option spreads as hedges, they're hedging against a particular move to the upside or the downside. They're trying to collect if the market stays neutral. This presents certain problems really by default, because generally you can lose if it goes far beyond the ranges. That's the key thing that makes option spreads at a standard level an issue, okay? But at the same time, there's good news. You can optimize this structure by moving the strike prices, right, and the expirations to get you a desired risk-reward outcome. What you should do is optimize it by moving the buying strike price lower so that it's already in the money, or at least close to in the money, right? And you want to sell the one that's a little out of the money to collect. And what happens is that you get more range for profit, okay? Because what you're saying is, technically, you don't believe the stock price is going to go beyond a certain range that it's not at yet, okay? But you've already bought an option that's in the money. So you're already covered in that regard if it does go a little farther, which is why you profit more to a particular direction if it does do that. This is optimized because now you profit fully out of one direction, albeit a little less if it goes farther and farther, but you don't lose money. You only lose money if it goes the opposite way that you anticipate, but you still get coverage, a lot of coverage, if it kind of plays within a longer range in this case. This is optimization. In the near term, you make money if the stock price goes beyond the planned range in your chosen direction, so you really can breathe a little easily. Now, let's talk about that fairy tale scenario I was talking about, right? Say, for example, back to this particular use case, say by February 29th, the stock price has not gone beyond this strike, right? Beyond 4,770. But at the same time, you do believe it's still going to go up further, right? You've collected all this money from that particular sold option, right? So whatever that was worth, you now keep all of that because the person you sold it to lost, okay? You keep that money, but you still own a call option, and you get to keep all this upside if it keeps going. So really, if a stock price goes beyond a planned range in your chosen direction after the sold contract expires, you really make a whole lot of money from there, because you not only make money from the actual the stock price going up from the long call in this case, but you also make money from this person losing and you selling it to them. So it's double dipping. These situations happen all the time, right? But you got to be able to capitalize and see them in real time. But this is only something that is possible with an option spread. Now, I'm going to actually visualize this for you as well. Let's go through a mock situation where, let's just say I am trading SPX, right? And let's just say I shorted it somewhere right here, okay? So technically I'm winning my short, but it's a long-term play, right? But now I'm seeing the stock is going back up closer to where I started shorting it at. So I'm getting a bit nervous, all right? Let's just say I see this day, and now I'm getting very nervous because it seems like it's about to be a bit of a bull run. I may want to get into a hedge, a bullish hedge, okay? Let's just say I do so and I get into a standard option spread. Just to review that again, this is the standard, right? A standard option spread technically is meant to bound the stock in a certain range where you profit at. So you profit as long as it stays within a certain range, okay? But the issue here is that, yes, cool, you now are profiting, but at the same time, if it keeps moving upwards in this time frame, you start to get screwed. And if it does dump downwards, now your hedge is hurt, which is kind of frustrating because technically you would have been better off just holding your shorts. So technically in real life, you're still nervous the entire time. It doesn't give you any comfort to know that you can lose on both sides of the market. You only win if by the time you sell, by the time your short contract expires, right, this becomes worthless and you take all the money. Of course, you can sell at any given time here, but you really don't want to, because the more you hold for option spreads, the more money you make. So, but my whole point here I'm trying to make is, if it goes upwards within this time frame, you're nervous. If it goes downwards, you're nervous as well. So neutral trades are hard to do at a standard level. Now, if you would optimize it by actually moving the strike prices and expirations more directionally, you now are covered as long as the stock stays upwards at all, okay? This is a much more easier hold because you're already short, okay? So technically your shorts are pretty covered. If it does go down, you're making money on the shorts anyway. But at the same time, if the stock still keeps going up, in this case, you're okay. That's a much easier hold. And you can hold it longer because really, generally stocks trend, especially upwards. So this is a much easier hold in this case while also covering your initial trade. This is especially optimal because if your portfolio has a directional bias like ours do right now, right, we can hold it. Like I said, option spreads make more money when they're held longer. So the whole point of a hedge is to be able to comfortably hold it. And in these cases where we only have to worry about one direction versus the other, this is perfect. And like I said, sometimes you can get a fairy tale situation where you can actually split the option, right? Sell or get rid of your actual sold contract and just stick with the long call and then make money off of that exponentially. So you keep the money from it staying within this range here. Once this expires, you now just hold your long call and now you're off to the races, right? And at this point, you really don't give a damn about your short because this particular hedge is making money for all of it, okay? Sometimes even outsized money compared to what you would have made on the short. So really, this is a very, very comfortable situation where if you're in the right hedge and you structure it correctly, it really could make your portfolio game much more efficient. And I really want to wrap this point up by talking about the benefits overall of using an optimized hedge trade for options, right, versus other asset classes. The most important thing is that you get to choose your level of risk, all right? It keeps losses low because you get to choose your level of risk. All option spreads, especially the ones I formulate, have a limited capped downside, right? Whatever you pay to get in to the trade is the max amount you can possibly lose, right? Just to make that point even clearer, looking at this particular example, right? Your entry debit is what you pay to get in. It's also your max loss. Unlike, let's just say, futures, right? You can have gap risk overnight. Now you have more loss than you anticipated. Same thing with stock shares. Same thing with commodities and currencies. Any other asset class does not give you the ability to choose your level of risk. Options do, especially option spreads for hedges. Number two, you get to leverage gains, obviously, right? Options are a leveraged product, so you get to keep the profitability high. You also get a comfortable hold, like I said before, with knowing that you don't have gap risk and knowing that you chose your risk. It's much more comfortable to hold, especially if you structure it in a way where it's low cost with high profitability. And lastly, you have the option, right, quote unquote, to split the trade for exceptional gain. Back to this example, right? You can split it and sell your sold option, right, for profit, and then just go with the long call or put that you have to get really exponential gains in this case. So once again, these are things that futures or commodities or stock shares, any other asset class can't do for you. Only option spreads can do for you. So that's why I love them for this, and that's why I'm going to use them. So now let's talk about finding an optimal hedge trade in the market, and specifically the one we're going to use for Q1 2024. And really we have to start with what to use for hedge trades, right? So to start, hedge trades need to be at a broader market level. Why? Because generally you want to hedge for overall market moves. You don't want to hedge for sector moves because you still have market risk at the overall market level. You know, you could hedge for, let's just say, the semiconductor sector, but if the S&P falls, it won't really matter because your hedge will get hurt. You definitely can't hedge for individual stock level because if anything happens at the sector level or the market level, your hedge is screwed. So overall, you need to hedge at the overall market level. If you want to hedge individual stocks against each other, you need to do something called beta hedging, which is an entirely different process all on its own. But for now, we're going to talk about actual trades for hedges. And it really comes down to two markets, the stock market and the bond market, right, where you can really do effective hedges. Stock market hedges are as follows. If you want to hedge the overall market, say for example, your portfolio is diversified, right, and you want to hedge the overall market, you would hedge the SPY, the S&P. Now, let's say your portfolio is mostly consistent of service sector industry stocks or large cap tech stocks. Say you're particularly long or short on them, you would then want to hedge with the Qs, right? The QQQ ETF, because technically they are over-indexed on mega cap stocks, particularly within tech and service-based industries. If you want to hedge with the mid cap or small caps, say for example, your portfolio has a lot of long mid caps trying to capitalize on that volatility, you want to hedge using IWM, right? Because that is the mid cap ETF for that. And say, for example, you want to hedge with industrial and manufacturing stocks. Say, for example, you are particularly bullish or bearish on the industry of manufacturing. You want to hedge with DIA, okay? Those are the four main ways you want to hedge within the stock market. Now, for the bond market, there's also effective hedges, particularly if you have an opinion on macroeconomic or government level situations, right? You have TLT, which is hedging long-term bonds. If you're expecting something to happen structurally and fundamentally to the bond market at a long-term level, you want to hedge with TLT. Same thing on the short-term side. If you're expecting either a divestment or investment in short-term bonds, you want to hedge with SHY. Now, say there's a situation where you believe a lot of the large-cap corporate companies are going to have an issue with liquidity. You would use LQD for that, and there's a lot of use cases for that as well. Say, for example, you think mid caps are going to take a dip or a rip, HYG is good for that. And say, for example, junk bonds, a lot of the small caps you think are going to rip or dip, you use JNK for that. It's also important that you really focus on what your portfolio is going to look like, right? You want to hedge on your portfolio's value, right? So say, for example, you have a whole bunch of mid caps. You want to use IWM. You would not use a bond, right? If you try to use a bond for a, let's just say, a mid cap move, then you just are really making an individual trade. You really want to look at your portfolio overall, or what your planned portfolio is, and use a hedge based on what you think is going to protect your overall portfolio of trades, okay? So don't just pick based off of what you believe is going to happen in a particular market. Do it based off of what your portfolio looks like, or planned portfolio looks like. And with that being said, if you have not picked up on this already, I'm going to use TLT. Why? Really, in my first video talking about my macro point of view on the quarter, right? I mentioned quite a bit on how I believe macroeconomic indicators are going to flip green, or have the risk of flipping green this quarter in a heavy way, right? And so all those macroeconomic indicators, I believe, will affect long-term bonds most, okay? Example reason is because, well, number one, long-term bonds are the most important asset class in terms of signaling economic stability and strength. Let me get this clear, right? We need as a country, the USA, the powers that be need to signal economic strength and stability in 2024. Why? Well, it's an election year, okay? The powers that be need a positive economy, or at least to signal a positive economy, because there has been no sitting president that has won re-election while the economic instability was still an issue, okay? So Joe Biden and his friends, and the Fed in particular, right, really want to showcase a positive economy, or at least produce signals of a positive economy. So it is in their best interest. They have a huge incentive to make sure that long-term bonds are invested in. So I believe they're going to do things by any means necessary to make that happen, right? And there's many ways you can do that, primarily using monetary policy, right? There's already been rumors around, let's just say, a stimulus to go out, right, to consumers to boost consumer sentiment, ding ding for that. There's been rumors about interest rate cuts, which of course will create bond reinvestment, right, because that signals long-term health into the country. Lower rate cuts signals more lower rate cuts in the future, which of course, when we're talking about long-term, this is where this wins. So both parties, both the administration and also the Fed, have vested interest in normalizing the government bond yield curve, right? And that really starts with long-term bonds. They're the most divested out of since COVID. Everybody was scared the USA was going to crash, so they sold their long-term bonds and started buying short-term bonds, okay? That's how the yield curve inverts. But now that the yield curve is normalizing, they're going to want to really bolster that for the election year. And I think it starts relatively soon, especially since Donald Trump, the main competitor, right, for the Democratic Party, has just won the Iowa caucus. So that puts some fire under the belt to make sure that the economy is shored up for the election campaign. So I do believe if any of these macroeconomic indicators change, TOT is going to flip green, right, across the board. So in my opinion, I want to hedge for that. If macroeconomic indicators change, TOT will get really hit hard, and I want to have that hedge for that. So I'm going to hedge specifically with TOT because of all these reasons. So now that we have our macroeconomic view on why that makes sense, aka the world view, and we have our industry view, right, in this case long-term bonds making sense for it, now let's talk about the actual stock technicals. So this is the monthly chart for TOT, the Treasury bonds 20 plus years. And if you just eyeball this without even knowing anything else, right, you can see that there is a clear support. We're talking about for 20 years, okay? Ever since early 2000s, this has been the support. That means through the financial crisis, 2008, right? COVID really hit it hard as well, right? But this is held tried and true as a low. Between 90 and 80 has been where it's kind of bounced off at, no matter what happens, okay? Now, we've seen it's had a downtrend ever since we had that big injection of capital, right, into the markets. Ever since we have quantitative tightening from there, market being the Fed taking money out of the market, we're seeing clear, right, downtrend back into this level of retracement. And of course, you get this big bounce back up 4 months ago, okay, with heavy investment. We're talking about more investment and more volume than ever before, at least in the last 20 years, okay? This is clearly a sign that the powers that be want to keep America afloat from a monetary perspective. That is huge support, all right? So generally off the chart alone at a long term, without even doing any other technicals, this tells me I want to be a buyer. I do not want to be a seller below this level. It makes no sense, right? And because we have that clear bounce for the last 2 months, this really could be as simple as a bounce, retest, fly up. Now getting into the lower time frames and putting on some SMA lines, we can see here that it's making somewhat of an inverted head and shoulders, or aka a bullish head and shoulders, okay? It was floating around the what is this, the 20 SMA, which is a monthly average price, right? Broke below that, made a head, right? Once it broke below the low, bounced right back up, retested the quarterly SMA, right? Dipped from there, and now this week it seems to be wedged between the quarterly and the monthly. And I believe, based off of what we know from technical analysis, if it does retest or gets close to retesting this SMA here, right? That could be the signal for most bulls to get long, especially if that retest coincides with any of the macroeconomic indicators I mentioned before happening between tomorrow and the 25th, really between tomorrow and the 30th, right? So this next week or two will be extremely important for bonds, because if any of those flash green and it sits here or between here, it likely will break this high and go play around with 110. That's the anticipation here. And there's even more coincidences here, because if you look at the actual trend indicators as well on the daily chart, right, you can see here a Fibonacci sequence, it's sitting right here at 61.8, right? So it's a clear from the low to the high, a very simple correction, still in bullish momentum. It's still bullish indicators. And here it's reacting off the 93.6 level, and that really could be the signal of a bottom here, right? So all those things in correlation with each other gives me much confidence that it might be time to get long on TOT right now before the option expiration cycle on January 19th ends. So I'm going to go ahead and do that. But to do so, I need to actually structure an options trade that makes sense. Let's get into that. So here I've modeled a trade, a calendar call spread in particular for TLT, that I believe gives me the proper risk reward that I want for the trade, and has a couple possible outcomes depending on what happens and when I decide to exit. So let's actually go with the first. I just kind of zoom in a bit so that you can understand what's going on here. So zooming in, I'm gonna start here at the top one, right? So assuming the current stock price right now is 93.60, which it is, right? And the target stock price at expiry, meaning where I want it to go, right, is $100. So it's at 93, it's going to go up 6.8%. If that happens, I'm going to get, well, assuming that happens, I get this contract, right? This is what I'm expecting. This is what I'm buying now, okay? I'm buying 2 long calls, right, expiring March 15th, right? Strike price 99, okay? I'm getting them for $60 a piece, right? And I'm also going to get the short. I'm going to short a call for February 16th, 100 strike price. I'm going to buy one of them, okay? And then I'm going to get $15 from the exchange to do so, because somebody else is buying it from me for $15, right? So 60 times 2 is 120, minus 15 is 105. This is what this entire trade will cost me, $105, okay? Now, using the actual current option contract prices in the market, if this stock TOT goes from 93 to 100, this contract setup, the longs will be worth 271, right, a piece. And also the short will be worth nothing, because technically it did not go above 100. So I win this bet, I keep the $15, okay? But my longs are worth 271 a piece, all right? So overall, it cost me 105 to get in the trade, right? But I make 541 in this case, right? So that actual risk reward, right? I'm sorry, I don't make 541 in this case. I make 556 because I keep the $15 in this case, right? So 556 profit in this case, minus the actual 105 here gives me a 4.3% win ratio, right? I get 430% in this case. If it does make a 7% move upwards on this trade. That is a great risk reward for one particular trade. Does it make sense? Now to zoom back out, give me 1 second. Here are 4 different scenarios for the trade, right? Assuming a different move, right? So if it goes up 6% or 7% in this case to 100, I make 430% profit because of this setup, right? All these are based off of existing option prices today. They only go up in this case because the market is pretty low. So if it goes up to 105 instead of 100 at February 16th, before the actual short expires, this is important too, right? Because in this case, now it goes beyond 100, right? Which means I have to pay more in this case for holding this trade. In this case, it doesn't expire worthless. It expires with something worth it. I have to pay out of my pocket to hold this because it went above 100. But still, because my longs are worth way more and I have 2 of them, right, the risk reward is still worth it, because in this case, I technically earned $1,400 off of this trade of 105, right? We got to pay out 462 because we went above 100. So in this case, even so, I still make 942. off that 105, which gives me a 800% profit in this case. And just going down the road, same thing, you know, if it goes to 110, I got to pay 981, but I made technically 1183 per contract that I'm holding, 2 of them, and so I got to pay out and make $1,400 off of $105. That is a 12.61% risk reward, so which is 1,261% profit. And of course, the best case scenario, if it expires worthless by February 16th, so I keep all the money here, don't have to pay anything out, and then it rallies to 110, right? Afterwards, after February 16th, I get to keep all the profit, which is, of course, is a 20-to-1. So option spreads allows you to actually model many situations and kind of get your risk reward based off what you want no matter what. Now, here's where a bit of portfolio modeling comes in. I'm not going to get too deep into it to confuse you guys, but I'm going to actually make this point across because it is important, right? Now, we're modeling a 100K portfolio, okay? This hedge trade only requires 9.3K of exposure, right, to cover 4 directional short trades that are 10K exposed apiece, right? Why is that? Because this particular trade, if we go back here, at minimum, right, has a 4-to-1, right? So in this case, if we do get a winning situation where it goes up 7% TLT, right, that covers a 4-to-1 ratio to these, right? This hedge has high power. And how do you get to that equation? Well, if you take $40,000, which is the exposure of the 4 short trades here, okay, and divide that by the reward ratio I get by owning this hedge, if it happens that way, right, you get 9,302, the kind of exposure I need to cover these 4. So my point I'm trying to get across here is that my one trade, my one hedge trade formulated right now covers the cost of all these trades here, if it does go in the favor of the hedge. So in the case of a hedge, if it goes up 7%, right, if TLT goes up 7%, these will likely be losing, right? Most likely will be going to either minus 80% or to 0, but it doesn't matter because my bull market hedge has at least 4-to-1 covering all the losses here. Okay. Now, to be 9.3K exposed to TLT with option contracts, all I would need to do is buy 1 option contract. Why do I know that? Because technically 9.3K divided by the stock price in this case, right, divided by 100, which of course is important because each option contract allows you the right to own 100 stock shares. Okay. That equals 0.99. All I need is 1 option contract exposed to the buy side to actually get 9.3K exposure to TLT. So that's extremely cheap, right? Because technically, even with my 2 contracts exposed on the buy side, it only cost me $105, okay? It only cost me $105 to enter a trade with 9.3K exposure to TLT, which covers 4 shorts, okay? That is extremely important to understand because technically, for the cost of $105, I now have covered 4 possible shorts at 10K exposure apiece, okay? That is extremely low compared to if I were to buy, let's just say 100 stock shares of TLT, which would cost me 9.3K. I now have hedged with less than 1% of the cost, right? Just because I formulated the trade in a correct manner. Option spreads are great hedges because they're cheap and they get you the exposure coverage you need. And of course, in the case that we get, it could possibly be a big winner for the portfolio. Now, let's talk about the cost benefit of this hedge trade structure, why it makes it top tier in this case. So most likely to get into our short trades at an options level, it's probably going to cost us actually about $300 a piece, between $300 and $500 a pop, right? Here's the thing though, right? Our hedge has firepower. It has between 4x to 20x firepower. If it does work out in our favor, it won't matter what these cost in reality because all 3 of these together, let's just say, assume these are $300 a piece. That's 12, right? If we go up to 110, this one hedge covers it. This one hedge covers 4 losses no matter what, okay? If the hedge doesn't work out though, I only lose 105. And these will likely be way in the money anyway. These will be profiting while I only lose 105 here. Going back to our original use case. We want to make sure our hedge, right, is low cost, right, so that we don't really care if it loses, but if it does win, it has high firepower to cover all of these, right? If it does work out to the soft target, even the soft target just to 100, okay, it covers the price of these at a likely level, especially at 10K exposure only. But if it works out exceptionally well and the market really goes into a bull run, I not only cover these 4 shorts, but also make a lot more money on top of that. This hedge trade then becomes a star in the portfolio. That is a brilliant type of hedge trade. And to really get that point across, right, I'm going to show you guys an actual visual of what the profit loss looks like here, right? So if by February 16th, right, as long as TLT is above 95.84, let's just say 96 to be exact, right, this trade is profiting. And the farther it goes up, obviously, the more money it makes across the board, okay? And this assumes the volatility as of right now. It likely, if it does boost, it'll go higher, right? So either way it goes, this is a good trade to be in as long as it's above 96 within a month, okay? I have a month for it to be above 96. But if it's, even if I decide, for example, I get nervous or whatever, right, and next week or so, I'm still in profit no matter what. It's at this point, it's a straight win no matter what you do across the board, right? So if I want to hedge and hold, it's a comfortable hold. I do believe in a month TLT will be above 96. That's the entire point of me hedging to the bull side, right? And generally, it's a cheaper trade. It costs me 105 to get in, right? The most I can lose is 105, but the profit in this case is theoretically infinite. Technically, I'm already up 5% on it, you know, just by getting in, because people are already buying into the same kind of hedge. I'm not the only one seeing this. So overall, this is the visual of it. And to visualize it from a chart perspective, this is where TLT is at right now. As long as it inches up, right, above 95 or 96 or so, I don't lose money, right? Which, of course, this trade gives me time to do that. That's the best part about option spread trades, is that you want to hold longer. You get more time to be right. You don't have to be nervous at all. And like I said, if it's up here somewhere, as long as it's up beyond 95 by February 16th, I'm winning this trade to the magnitude of possibly 4x or more, right? 4x, not 4x, 4x, 400% or more, right? But I even have the option to split it, let my sold call expire worthless and hold the long call and just make money along the way in this case, and just in case we get a major bull run. So in my opinion, this is going to definitely be my trade, right? For Q1 2024, entry cost is 105, right? I don't need more than that, because for my 100K portfolio exposed, that's all it's going to cost me, 105, right? Stock price and entry is 93.60, which is today. Anticipated stock move by February 16th is plus 6.84%, or to touch the 100 level. If it does that, this trade does its job. It covers my shorts completely, and my longs, of course, will be long as hell. But more importantly, I have only cost me 9.3K to get in, so less than 10K. So I can't be happy with this particular result for the hedge trade. I'm going to now look for longs and shorts, and I have 90.7K of exposure left to spend for this 100K portfolio.